Welcome to today's What Will Move the Market show. I'm your host Prem. It's Monday, January 19th, 2026, and here is everything you need to know as the markets open for today. Let's start with Wall Street's overnight performance. The US markets finished last Friday on a cautious note as mixed signals from policy uncertainty continued to weigh on sentiment. The S&P 500 declined slightly, closing at 6,940, down 0.06% or 4.46 points. The Dow Jones Industrial Average edged lower by 0.17% or 83.11 points, ending at 49,359.33. The tech-heavy Nasdaq 100 followed suit with a modest retreat of 0.07%, sliding to 25,529.26. These declines reflect ongoing concerns about trade policy uncertainty and geopolitical tensions, particularly following President Trump's fresh tariff announcements over the weekend, targeting European nations and Iran-linked entities. Despite the weakness, the declines remain relatively contained, suggesting measured positioning ahead of the week and corporate earnings season ahead. Now let's look at our Indian ADRs. Infosys, our IT powerhouse, opened low at $18.63, down 1.01% as global tech sentiment remained under pressure from macro uncertainties. HDFC Bank, our banking flagship, showed relative strength with a gain of 0.43%, trading at $32.65, supported by strong quarterly earnings and solid asset quality metrics. ICICI Bank held steady near $30.87, up 0.16%, reflecting confidence in the banking sector's profitability despite broader market caution. Reliance Industries, meanwhile, faced notable headwinds, declining 1.98% to $64.40 after mixed results, with profit taking evident as the market reassesses commodity-linked valuations. These moves underscore selective strength in banking while IT and energy stocks face consolidation pressure. Turning to Asian markets and our key forward indicator, GIFT Nifty. The GIFT Nifty 50 index futures closed at 25,570.50, down 0.65% or 168 points, signaling a moderately weak opening for domestic equities. This suggests the Indian market will open on the back foot, though the decline remains measured. The Japanese Nikkei 225 closed lower at 53,130, down 1.05% or 564 points, reflecting yen strength and profit-taking in cyclicals. Hong Kong's Hang Seng finished the session with modest gains of 0.14% or 38.30 points, settling at 26,585.10, showing relative resilience despite regional headwinds. China's Shanghai Composite declined 0.27% to close at 4,688.87, marking continued weakness as policy tightening measures and weak economic breadth dampen sentiment. The mixed performance across Asian bourses highlights the current cross-current of trade concerns and policy support. On the global geopolitical front, markets remain on edge from intensifying trade policy uncertainty. President Trump has escalated tariff threats over the weekend, announcing plans to impose fresh duties on multiple European nations starting February 1st, with warnings of further increases by June, unless the US is permitted to acquire Greenland. Additionally, new threats of 25% tariffs on nations conducting business with Iran have reignited concerns about a broader trade war unraveling the fragile truce reached with China. These developments have injected fresh risk aversion into global markets and will likely impact corporate profit margins, particularly for export-dependent sectors. For India, the immediate impact remains measured, but deteriorating global growth would directly hurt our IT, pharma, and engineering services sectors, which remain highly dependent on Western markets and trade flows. Domestically, investor sentiment reflects mixed signals. While earnings season has begun with some IT and banking names delivering solid results, broader market weakness persists, with nearly 70% of Nifty 500 stocks trading in negative territory, marking one of the weakest January starts in recent years. Institutional flows show domestic investors maintaining their support, with DIIs recording robust inflows of over 3,000 crores on Friday, while FIIs continue to pull back due to global uncertainties, offloading positions worth 3,000 crores. The Indian rupee has weakened further to 90.84 against the dollar, approaching fresh lows as global risk-off sentiment drives demand for the safe haven US currency. The RBI has signaled its accommodative stance, having cut the repo rate to 5.25%, its lowest in 3 years, with scope for further easing if domestic growth faces headwinds. From a technical perspective, Nifty 50 faces immediate resistance near the 25,700 to 25,800 zone, with a decisive close above this level necessary to trigger fresh momentum. Support holds at 25,500 to 25,480 levels, representing key zones to watch. Bank Nifty, which has shown relative outperformance, finds support at 59,500 to 59,200 marks, with resistance building towards 60,400 to 60,500. Both indices are consolidating below their key moving averages, though selective strength in quality financial stocks provides a glimmer of hope for further recovery. On the commodity front, crude oil remains under pressure, currently trading around $59.28 per barrel, up just 0.08%, as geopolitical concerns compete with demand uncertainties. Gold continues to attract safe haven flows, climbing 1.41% to $4,660.42 per ounce, supported by global policy uncertainty and expectations for continued central bank accommodation. Silver outperformed with a gain of 3.31% to $93.06 per ounce, reflecting expectations for easier global monetary conditions. Natural gas surged 11.47%, climbing to $3.1750 per unit, marking the strongest commodity move, likely driven by seasonal demand and supply tightness. As you navigate markets today, exercise disciplined caution given the mixed signals we're seeing. GIFT Nifty 0.65% decline suggests a soft opening, but the magnitude remains limited, indicating no panic-driven selling from overnight flows. Watch the 25,700 zone in early trade as a key barometer of sentiment. If we hold that level, selective long positions in quality banking and defensive IT names on dips could offer tactical merit. However, any break below could warrant a reassessment and more cautious positioning. Avoid chasing weakness early in the session, and instead allow the market to establish its conviction before committing capital to fresh trades. Stay tuned for the evening wrap, and send in your questions and subscribe to this podcast to hear US every morning.